What's up, owner investor? In this video, we're going to talk about how to evaluate the overall risk reward of an investment. Okay, so all of it is really just going to come down to like creating this kind of a forecast. And for most companies, you'll be able to do it with this simple valuation spreadsheet. But I wanted to do an example where it's a little bit there's like some kind of complexity, which is this negative working capital situation, so that you won't be able to use a simple valuation. But for like Costco, you should be able to use this, and then you'll use this aspect of the analysis to kind of come up with a reasonable return on equity. Um, and Because like right, so if I were to calculate the return on invested capital for Airbnb, it would be like on a pre-tax basis, it would be this divided by this, and it's going to be a negative number, right? It's going to be like meaningless. Um, so for the risk reward, it's basically like you have to think probabilistically when it comes to investing. There's always like different scenarios that can unfold. Um, and you want to make sure that it's kind of a situation where it's heads I win, tails I don't lose much, right? So with something like Airbnb, the things that I would want to kind of sensitize for are like these three variables, right? The growth in the growth in the TAM, I think that's kind of whatever 5%. That's fine. Like, com, you know, that's something that maybe we can be a little more comfortable about. But the really key question is like, how fast will this market penetration grow, right? So if this grows at 5% and the multiple is like 15 times, right? You're flat for like over 10 years, right? Um, Versus you could have put that money in the S&P 500. Um, let's just see what kind of beta that Airbnb has, just so we're not doing something. Yeah, finance. It's gonna have a pretty high beta because it's a growth stock. It's gonna be a lot of noise. It hasn't been public for very long. Yeah, it's just like, not even look at the beta right now. But this isn't very good, right? If the growth rate slows to 5% instead of what do we have this for 15% versus 5%, and this multiple gets crushed to 15 times, you're flat for 10 years, right? Versus, if you got like S&P 500 returns at 1.1% for 10 years, you would have at least 2.6x to your money versus here. Not only you're like you lost money, right? Like you lost like 30% of your capital, right? So if you invested $100, in 10 years, if this happens, 5% growth average for 10 years and 15 times multiple, you would actually end up with $70, right? So $100 would turn into $70. And in that same situation, if you had invested in the S&P 500 and, it does the kind of standard, let's just call this like 8% return, you would have turned $100 into 216, right? So that's kind of, let's just say that this is like, we've done the work, this is a downside scenario, right? And then the upside scenario is this 15% and 25% growth, right? So, downside case is like zero point 0.7 times. And then upside case is, 8.4x. And then let's say your kind of your base case. This is all stuff that would take like a lot more research and analysis, and something you want to get kind of comfortable with. But for the sake of just showing you mechanically how this works, I'm just kind of going a little faster than I would otherwise like. But let's just say instead of 20%, they do like 15% total, so this comes down to like 10%, right? So then this would be like a 3.2x, right? So then again, this is all like this is art, not science, and so again, take this with a grain of salt, and it's not like you shouldn't be like precise down to like 20 decimal places with stuff like this. But this is kind of like what your skew looks like, right? Like you could either 0.7x your money, 3x your money, 8x your money, right? 3.2x, 8.4x. So the key question now is like, what's like the rough probabilities of each of these scenarios, right? If you do the work and you think, the probability of, this is kind of your downside case, this is your base case, this is your upside case. If you do the work and you think that You're more bearish on the stock. You think that, there's like a 30%, like a 50% chance that this is going to happen, 25% chance of this, like 30% chance of this, a 20% chance of this, right? Um, Center line this, colors blue. So then, your expected value would be this times this plus this times this plus this times this. So your expected value would be to roughly 3x in 10 years, right? Which comes out to a 12% rate of return, right? So then it's up to you to kind of decide, like, is that a reasonable enough rate of return? And then the question is, okay, I think it's reasonable. Like, how much should I own? Is this going to be like a 1% position, a 5% position, a 10% position, a 15% position, 20% position? Um, you know, I think like there's no hard and fast rule, but generally you want to limit the position size based on how much losses this could contribute to your portfolio, right? So, like for example, if there's a 50% chance that you're gonna lose, you're gonna end up with a 0.7x in 10 years, that should kind of limit your position size, right, to the lower end of the spectrum, right? Um, Especially if like the downside case was like a zero, and there's like even like a 30% chance of that happening, you really want to limit that, right? Like if you put like 20% of your portfolio and the stock goes to zero, you lose 20% of like your portfolio, right? Like your savings. So definitely want to be like very careful in terms of the position sizes, and to the extent that you're a beginner and you're older and again, not financial advice. This is just kind of how I think and how I think about sizing for my family. Um, Generally, with myself, I'm more aggressive on the position sizes because I do more research. Like, I did this as a profession for many years. I had access to expert networks. Um, and my net worth was growing rapidly every year from all the income that I was generating from my job. So for my personal stuff, I would size, back when I was at the family office, like I would size stuff in my personal portfolio at a much higher level than I would size for my family, right? For my parents, where they're older, and their net worth isn't increasing at such a rapid rate because they've already built up so much net worth. And they're approaching retirement age, and they're going to have like healthcare costs coming up. Something that maybe I would size at like a 20% position might only be like a 5% position for my parents. Again, like if you think that there's only a 20% chance of this happening, and if you think there's this is like kind of rock solid, and you think there's like a 30% chance of this, that comes out to like a 15% expected return, right? Like a mid-teens return. Uh, for and the other risk you're taking is with this is a growth stock, right? So it's trading at uh, 51 times earnings, right? Because I guess we're using 2023 numbers now. Yeah, okay. The 260 instead of we were using the 335 before. Okay. So if interest rates like continue to stay elevated, and growth stocks continue to get hit, this multiple over the next few years could end up coming down. And so what might happen with the returns is like in the next 2 years, you might be down like 50%, and then it takes like 8 years to kind of, slowly rise, right? So remember, we're looking at this on a 10-year view, right? So that means like these returns can fluctuate a lot in the over the 10 years, right? Like Airbnb could be down like 60% like this year, right? And so that's why like it's very, very difficult to be a long-term thinker when stocks are moving every day, like every second, right? So when something's down, like you own it and it's down like 60%, it's really hard not to like let that phase you, right? And so that's where the research comes in. That's why when stocks go down, it's like if you were buying clothes and it goes on sale, only if the value you have a lot of conviction in the value and you've done the research, um, and you've done the work, and then that's why. So then you say, okay, the price has gone down, but the value is the same, right? But if the price has gone down, and the value's gone down even more. That's actually you want to sell that, right? So that's why this is such a challenging exercise, and I think that's why I think a lot of people just want to own the index, which is totally fair. But if you enjoy this game, this is how you can learn about businesses, and I got a lot of startup ideas and intellectual development, and I love doing this because it's like solving a puzzle for me. Um, but you'll find out very quickly if you want to play this game or not, or if you just want to own the index, or if you just want to have someone manage your money and you don't want to deal with any of this stuff. But it can be very nerve wracking. And if you don't do the research and if you're not intellectually honest with yourself, it can very quickly turn into gambling, despite doing all of this analysis. So yeah, it's a tough game. I enjoy it. I think it's a lot of fun. I've learned a lot from it. It's really been rewarding for me from a personal and professional standpoint. Um, but yeah, that's it for this video, and I'll see you in the next one.